Hey there, it's Erin with Time Saving Templates, and I wanted to go over some basics around bookkeeping and Schedule C that apply specifically for small handmade business owners. So I'm glad to be finally going over this to help answer some of the questions that I get a lot. So I'm going to go over some of the basics from Schedule C. Once you determine what it is you need to track, that's going to help you decide on which template will work best for your situation. So I'll go over that too. So the Schedule C is a tax form that applies to U.S. businesses that are either a sole proprietor or a single person LLC. If you use something like TurboTax or an accountant, you probably won't actually fill out the Schedule C form because they'll just ask you, the questions to help determine, what to put in the form. It's still good to be familiar with how the Schedule C works so that you can be prepared and track the right information that you're going to need. And I have a disclaimer that I'm not a tax professional. My corporate experience is with HR and compensation and Excel spreadsheets. And so my expertise is in designing the spreadsheet solutions for a variety of areas, and one of those being for small handmade businesses, because I had my own handmade business where I had to report inventory and cost of goods sold for over 5 years when I was selling jewelry and wine charms. On top of that, I also get a lot of customer requests for different spreadsheet templates that can help with tracking these sort of things that go with the Schedule C. So that's where my experience comes from. So if you have any concerns about your tax situation, I would definitely advise you to contact an accountant or tax professional that can review the specifics of your situation. While there are differences in the smaller details, most tax reporting can fall under a few main areas: your income and sales, your expenses, and your inventory. And the main thing here to note is that you're only going to pay taxes on your profit. So that's why it's important that we use as many tax deductions as possible. My goal in doing this is that you would find a system and template that works for both your tax purposes and for your own purposes. Because if we're already tracking data for one area, why do double the work? It usually can just be a few tweaks and you can accomplish what you need for both your taxes and your business analytics. This is the Schedule C form, and you'll see up here at the top a link to the actual form at the IRS if you want to go print out the form to get familiar with it. Basically, it just asks for some basic information at the top and then the accounting method. We're going to go over that in the next slide, but the next section, part 1, is your income, and we're going to go over the cost of goods sold, which is on the second page, and then expenses, part 2, and these are some of the different expenses or deductions you can use. So looking back at whether you can select cash accounting or accrual accounting. So with cash accounting, this is the most common method used for small businesses. And this is the method where your receipts are recorded during the period in which they are received, and the expenses are recorded in the period in which they are actually paid. So, and by period, it's usually the calendar year. So everything that you purchase within a calendar year falls into the expenses within that year. This is the second page of the Schedule C. This just shows some more expense categories here. And also, I just want to note supplies right here. I'm going to go over the difference between supplies and inventory in the next couple slides, but just want to point that out. And then, so basically you're going to add up total expenses, and then your net profit is, of course, the sales minus the expenses. Now, here is the this is actually the second page. This is the cost of goods sold section, and you'll see that at first, in the first part, you'll list your inventory at the beginning of the year. And if it's different than last year's closing inventory, you have to attach an explanation. So you want to make sure that you're being consistent each year in the way that you track things, and also that your numbers match. So you'll put your beginning inventory there, and then you'll add in purchases, materials and supplies, and other costs related to the items you're selling, and then the inventory at the end of the year. Then we have the cost of goods sold, where you subtract line 41 from line 40, which is 40 is just totaling all your inventory plus purchases. Now, I just want to make a note that there's two different methods you could use to calculate this. So method one, you've got your beginning inventory plus purchases, materials, supplies, minus your inventory at the end of the year equals your cost of goods sold. So with this method, you're just going to need to track beginning inventory, your purchases throughout the year, and you're going to do a physical count of your inventory at the end of the year. You don't actually need to track cost of goods sold if you use this method. Now, the second method, and this is one that I preferred to use, was you're still tracking your beginning inventory plus purchases. That part's the same, but you're going to subtract your cost of goods sold to get to your ending inventory. So with this method, I just tracked the cost of goods sold throughout the year, and I don't have to do an ending inventory count because I can get that from this calculation. And I'll do another example in the next slide too, if that is confusing. But I also wanted to note that the form also asks about mileage. So I do have a mileage tracking template that you can download, and I also recommend to print it out and keep it in your car. That way you can remember to actually write down the miles as you go. Okay, so back to the way you're calculating inventory. This is just another example. Both methods start with your beginning inventory as of January 1st. And so it should match your ending inventory that you reported the previous year as of December 31st. Then throughout the year, you need to track your purchases and your materials that occur anytime throughout the year. Now with method one, we're going to subtract ending inventory as of December 31st of the current year. So you'll actually do a physical inventory at the end of the year, or you can keep track of your inventory throughout the year, so you already have an accurate inventory count. And so you just subtract that from the above, and that will give you your cost of goods sold. If you want to go with this method, I have I have a few inventory templates, but if you're specifically doing this method, I would go with the annual inventory worksheet. Now, if you don't want to have to do the physical count of inventory at the end of the year, I would go with method two, and this involves finding out your actual cost of goods sold. So tracking each item that sells and calculating the cost of the materials that went into that item. So if we subtract the cost of goods sold from the two items above, that will give us our ending inventory. And with this one, I recommend using the cost of goods sold pricing worksheet, because as you're entering the materials that go into each item, you might as well be pricing the item or getting an idea of a recommended price for the item. And at the same time, you're keeping track of the cost of the materials in the item for your cost of goods sold. And all you have to do is go back and count and mark how many of each item had sold, and the template will add up for you your total cost of goods sold. So if you do use the high volume seller system, which is an inventory system that we'll go over, then your cost of goods sold and pricing worksheet are in that system, and it's all linked together to help with a lot of other things too. Okay, so real quick, I wanted to also mention the difference between inventory and supplies, because I've seen a lot of confusion with that sometimes. And so inventory is anything that becomes part of the product that you sell. And inventory is considered an asset by the IRS. So if you're first starting out, a common misconception is that if you spend money on inventory for your products, that you can write that off as an expense, but it's not considered an expense until you sell the product. So once the product sells, then you can use the cost of your materials as a deduction, and that's based on the year that it sells in. So if I had bought inventory and materials for different products, and in one year, and the product doesn't sell until the next year, I don't get to take that deduction of the cost until the year that the item sells. It doesn't matter that you purchased it 2 or 3 years ago. As long as you have the receipt and you sell the product, then you're good to go on using that deduction. Now with supplies, these are things that are not part of your finished product. So items that are used or replaced usually are supplies. And for example, paper, notebooks, pens, ink cartridges, and that sort of thing. Things that are used up. And that's it for a basic overview of the Schedule C and inventory tracking for your small business. And I hope that this will help point you in the right direction and help you figure out what way of tracking that inventory is going to work out best for you. And if you liked this video, then feel free to subscribe to my channel for future video updates where I do Excel spreadsheet tips and template demos, and sometimes tips like this that help explain why certain templates are set up the way they are. And you can also visit my website at timesavingtemplates.com. Thanks again for watching, and until next time, remember that I'm here to help you streamline your spreadsheets and get organized with Excel templates.